Good afternoon, everybody. It is August 19th, Wednesday, and you've got me again, Micah Haints, Senior Sales Associate from Noble Gold Investments. It's just me today. We won't have our fearless leader, Colin, with us, but we'll cover a few quick things, what's breaking the news and what's happening in the gold market. So we'll get right into some breaking news, hitting new record highs for the national debt. Finally breaking 40 trillion. It's been some time now that I've been rounding up from 39 and change, saying we're almost at 40 trillion, but we now have total US debt officially above $40 trillion. I think obviously we're going to see more of this, more debt accumulation in the years to come with everything that's going on and everything that I'll explain. But this is a big key level. Now, one of the things to mention, I talk a lot about in our podcast, is that we have already crossed the Rubicon, the point of no return. Historical precedent for any country that has a debt to GDP that rises above 120%. There is no exception to that country going bankrupt. There is no exception to it at all. However, as a currency issuer, it's very unlikely that we will default on the debt. What we end up doing is printing money to be able to service the debt. Service debt costs are now the biggest line item in the budget. We know that changed last year when debt servicing surpassed $1 trillion in the budget every year. Now we've got a budget deficit of over $2 trillion. So it's just about half of the cost of the deficit. And I'll bring up this next clip with Bill Clinton. I just thought for historical context, it wasn't all that long ago, 1998. I would have been 9 years old. But we actually ended 30 years of the prior 30 years of deficits, and we actually finally delivered a balanced budget in the budget of 1999. Well, obviously in the last, 27, 28 years, we've gone from not just a balanced budget to a massive annual deficit in excess of $2 trillion. And now, again, this big milestone of hitting a national debt in excess of $40 trillion. Like I said, I think we're past the point of no return. And what we'll see moving forward is interventions from the central bank, interventions from the Treasury to cap long-term bond yields, to engage in yield curve control, or YCC type of modern monetary theory, or monetarist intervention to basically keep the bond market from blowing up. So in this next tweet, I want to talk about this. This is actually the government servicing cost now that we're rolling new debt at higher long-term rates. Now you have to think of bond rates and long-term bond yields as actually being the rate that we pay on our own national debt. Now we're rolling a bunch of old debt into this new higher debt, and this analogy from the Kobayashi letter, which I like and follow, think they put out fantastic information. I'll just read this for those who don't have their spectacles with them. What the government is doing now is the equivalent of holding a 30-year mortgage at a 3% rate and refinancing it into a 4% one-year adjustable rate mortgage. In other words, you're replacing longer-term, lower-cost debt with shorter-term, higher-cost debt. And now apply that to trillions, 40 trillion US dollars, and that's effectively why the US Treasury is being forced to do long-term, a long-term yield surge, or yields. We'll talk about them buying their own bonds. But it says, unfortunately, the Treasury is largely playing the hand that it was dealt. Sure, this one's inheriting the debts from prior. We know that every presidential term, essentially the debt doubles. So from Bush to Obama to Biden and Trump, we have effectively doubled the debt every presidential term. And what does this mean? So I already mentioned, this is the scary part, is that we have the highest debt in the nation's history. We have the highest yields that we've had since the crisis in 2008, the highest interest that we're paying on the debt. And it's the equivalent of you essentially not being able to pay your credit card, right? Your credit card bill is essentially in excess of what you make every year. But if you can print money in your basement in order to pay that credit card bill, you're not going to go bankrupt. What you're going to do is you're going to destroy the currency by printing it into infinity in order to come up with enough to make those payments. Now, the other thing that we see, which is news from today, we'll pull up this Treasury news release, this Treasury, and so we'll get into why gold and silver are reacting so strongly today. In large part, it's because of this, but the Treasury is announcing increased sizes of buying the nominal long end of the yield curve. So essentially, they're buying longer dated bonds. So the US Department of Treasury is increasing by at least double the size of liquidity support buyback operations for longer dated nominal coupon securities, the 10 and 20-year sector and the 20 and 30-year sector. So the current maximum size of 2 billions per operation will be at least 4 billion per operation. Now, what does this mean and what's been going on? We know that Japan has been selling treasuries. China has been selling treasuries. Much of the East has been selling treasuries for the better part of the last 2 years. Actually, China hasn't added to their treasury holdings since 2012, so almost 15 years in the making. And the trend, the long term trend of dropping dollars in favor for physical gold as an actual neutral reserve asset that has no counterparty risk. We know that sovereign nations have been engaged in this for quite some time. Now, it was back in the fall of 2025 when, for the first time in 80 years, the amount of gold held abroad actually surpasses now the amount of foreign holdings in treasuries. And again, that's just an indicator of the trend that people don't want dollars longer term, they want gold. But the selling of treasuries is a very interesting concept, I think is lost on most. When you're selling bonds, you're pushing the price down. When you're selling stock, you're pushing the price down. When you're selling gold and silver en masse, you're pushing the price down. Now, what happens with bonds, think of it as a seesaw. If the price of a bond goes down, meaning there's people selling it and not enough people buying it, then the yield rises. And that's what's been going on. That's why we have the highest yield on the 20 and the 30 year in over 20 years. But as bonds get sold and rates move up, then you're actually having, again, national debt servicing cost, but all of our commercial financial instruments are also based on long-term bond yields as well. Mortgages, car loans, credit cards. So it's extremely recessionary, and it's contracting credit, making it harder for people to access at much higher rates, or by making it more expensive to service existing debt at much higher rates. Think of it, you're not making any more money, but your actual cost of servicing your debt goes up. That means you have to take that money away from somewhere else, which is recessionary economically. Now, what happens is we are buying back our own bonds, and we have been for some time, but now we're doubling the amount of money that the Fed is printing in order to buy back these government bonds. And the reason is there are no other buyers. Colin and I at our last live talked about how the Treasury auction at the end of July, we ended up having to buy $2 billion of our own bonds because they just went no bid. Right. So it's not that just that people are selling it like crazy. There's no one left to buy except for us. We are the kind of the buyer of last resort. And as investors and as citizens and as people who are trying to save and live a good life, our dollar is being printed in order to save the bond market and to slow the eventual inevitability of the government going bankrupt and having, again, skyrocketing national debt and skyrocketing debt servicing costs. But the problem with that is they're adding to the debt by essentially buying their own bonds back as well. So it's there's a Greek symbol called the Ouroboros. It's essentially the snake eating itself. It's just a doom loop. We can't really get out of this without having a major crisis of some sort, where either the bond market blows up, the stock market blows up, or the currency itself fails. And I think that's obviously what we're headed to. Now, gold's reaction to this today, very strong. And obviously that comes as no surprise. We shot up $180 in just a single day, breaking 4,500, which for technical analysts was a big key level. We're still a ways off from the $5,500 mark that we got to in January. But today, I think I'm seeing this trend, and a lot of people talking, a lot of analysts talking, that this is the catalyst that we needed to actually get up out of this consolidation that we've been in for the last 6 months. And it's very encouraging that the metals are reacting so strongly. And of course, silver reacting positively as well, up over $3.30. And on a percentage basis, it's no shocker that silver always outperforms gold, both to the upside and to the downside, as mini gold on steroids or leveraged gold. Silver's a much thinner market, so it reacts a lot more strongly. But again, coming out of this consolidation, just a couple of weeks ago, we were at $55. very, very positive to see the silver price up here. And again, I think the consolidation's over and reacting just in time. So we've had, the FOMC meeting from a few weeks ago at the end of July where they're not raising, but not lowering. They're worried about recession. They're worried about inflation. They can't do much about either without causing the opposite. And so we're in this stagflationary period. You've got a stock market bubble we've discussed at length. You've got a bond market bubble and a bond market crisis that's brewing now. And then you've got a national debt crisis and a debt servicing crisis, and the interventions from the Fed and from the Treasury just make these matters even worse. So obviously, longer term, we were strong believers in holding a solid core position of your portfolio in physical gold and silver so that you're hedged against currency risk, institutional risk, and all these other things that we need to be afraid of. Now,
Micah, can you hear me?
yes, I
So
can.
why aren't buyers showing up into the bond market? Like, is this what we see when central banks are buying gold now instead of bonds? Is that what's missing?
Yeah, so I just had the question that why are people not buying bonds, and why are people selling bonds? And I did just touch on that briefly. So it's again, long-term bond holders don't think it's twofold. One, they don't think that the dollar will actually be worth as much 20 years from now, 10 years from now, and the yields that are being paid are not enough for them to want to hold that. That's obviously because we believe that inflation's here for the long haul, and that higher inflation is the part of the financial reality that we're coming into. We had a period from 1982 to 2022, a 40-year period where rates only went down. Now we have a period, and it's a new secular period, where we have probably the next 20 to 30, 40 years where rates will really only go up. Now we have a secular inflation cycle, and again, that's bad for fiat, that's bad for non-dollar denominated, or sorry, for dollar denominated assets. But again, bond holders, whether it's a institution or a billionaire, hedge fund, or a country, they don't want to have to be overexposed to bonds and to long-term government debt because of all these various risks, right? If you're owed money by a government that could eventually go bankrupt, which again, having crossed the 120% of GDP, we're at 128%, I think, as of this week. It just doesn't bode well for bondholders long-term to be able to count on that money being there or being worth anywhere near
Because that's
what
like
it
a
is
fixed
now.
asset essentially, then, right? And you don't want to get locked into a lower rate later on. Is that
That's
why?
yeah. So the question was whether or not you don't want to hold a fixed asset where you're locked in at a lower rate. It's, you will earn that yield every year that you hold that bond. So if it's a 5.2% yield on a 20-year bond and you have $100,000 in it, you're making $5,200 every year to hold that bond. The problem is, and the question is, will that actually outpace inflation? The answer is no. And so people do not want to hold $100,000 of bonds at 5.2% because in 20 years, that 5.2% that you're going to collect is not going to actually make up the difference in terms of real inflation. Now, we know that real inflation is higher than what the CPI or the government says that it is, somewhere around 3%. In reality, we know that if you look at food inflation, commodity inflation, all the things that we need in our day-to-day lives, I think we're probably in the 6-7%. Now, the idea, though, too, is just having exposure to the dollar. People don't want that. So again, that seesaw of selling bonds raises yields, and that's what's making government debt more expensive. Now that should be enticing to people who want to buy in now and have and collect that coupon or collect that higher yield, but it's still not enough incentive. And I actually think that long-term yields have a date with 6 or 7%. That'll be incredibly recessionary. But by that time, we'll actually probably have to double again the amount of treasuries that are being bought internally, because again, there are really no big buyers in size of US debt anymore. China, Japan, the East, all these big countries used to buy our bonds, and now we just can't expect anyone else to. So we again have to step in as the buyer of last resort and buy our own debt back at the expense of weakening our currency even more, which is a very scary setup. So what I was saying earlier about obviously de-risking from currency exposure and financial institution exposure, third counterparty risk. Owning physical gold and silver is a key part of that, and everybody needs them in their portfolio. But I'm not the only guy that actually loves gold. I mean, yeah, I'm a gold bug, dyed in the wool, going back 10 years. Been happy to work here in my dream job at Noble Gold for 6, but don't take it from me. Take it from Scott Bessent, who is the Treasury Secretary, who's been talking a lot about gold as of late. But I want to play this
Gold,
clip from him, which is a year old now. But let's hear what he has to say about gold.
gold, gold also has other applications, a lot of applications, jewelry in India, but it's something that historically people have all agreed on. And gold can't have a fiscal problem. Gold cannot have a gigantic budget deficit.
Correct.
Gold cannot have a war. So just the fact that it is this isolated thing makes it very interesting. And the fact that the entire global trading system, until Richard Nixon took us off, was tied to gold.
So you're not anti-gold?
Oh, no. When I had my fund, I think people might have called me a gold.
A fellow gold bug in our Treasury Secretary. So, that is an older clip. I won't say that that's from today or that was from, I think, March of 2025. So that was just as he was kind of coming into that role. But yeah, when he was a fund manager, his biggest position was in gold. Obviously, he's been talking a lot about the gold in Fort Knox, saying that it's all there. I don't expect him to say anything else. I don't actually believe that it is, or that we have the most. But anyway, we've heard a lot about gold revaluation and all these things. I would say, what's most important for people to think about right now in the current context of all the stuff that's going on. We've talked about the Japanese carry trade. We've talked about the currency interventions that were had with the Japanese yen. First time in 28 years that the US has sold euros to buy yen, to prop up the yen, to prevent the Japanese from selling US bonds to then buy their own yen. And again, us doubling the amount of bonds that we need to buy to keep them propped up. And this idea of yield curve control, it's inevitable. It's kind of what we're doing now with quantitative easing, but it's the idea of buying your own bond back so that you're pushing it up in price so that you can actually cap your yields. We are going in that direction, and then that leads to a whole other can of worms. So I'll leave it at that for today.
Oh,
40 trillion
we have a
in
few.
debt.
We have a few questions actually.
Sorry, we have a few questions coming in. Sorry, I'm gonna.
I know we're talking about a lot about when to buy gold, but how about we have a question? When do we liquidate? I'm thinking of liquidating some funds to buy more stuff. So when do you recommend liquidating, or when's it a good time?
Yeah, well, in terms of liquidating stock or bond, I would go ahead and do that kind of bonds. I do go ahead and do that right now. I think that the big risk is that the two biggest bubbles, or actually the three biggest bubbles in asset markets, are stocks, bonds, and housing. I think that gold obviously is not at 2000 anymore. It's doubled from a couple of years ago. I think it'll continue to double over the next few years too, because we have these big bubbles in other markets where there's going to be nowhere else to park your money. There's going to be nowhere else to actually protect your capital. Gold and silver are the oldest, safest asset classes of all time. And there just so happens to be a time and a place when owning gold is not only the safest, but it pays you the best. And we're in that now. You have to look at the warning signs of, again, what's going on at the global macro level, in the bond market and the stock market. So, trimming your stock portfolio, which is at all-time highs. Don't get me wrong, stocks are at all-time highs, but that's what I'm saying is this is the most overvalued stock market of all time. Even the Bank of International Settlements, which is the bank of central banks, I've talked about this on our own live stream, but also another podcast, they issued a warning saying this is the biggest bubble of all time. It's worse than the dot-com in 2000, worse than housing in 2006, worse than the GFC in 2008. So, tie it all together, and I think we're going to have a pretty interesting time. So, I'd rather sell stock and trim profits and lock that up and protect that in gold 6 months to a year too early rather than, a day too late. So I think it's a great time to be considering adjustments in your portfolio for sure.
Yeah, that's good advice. And now we have one more. What will happen with the housing market? Where do you see?
Yeah, we already see data showing that we have the least amount of sales in 30 years, or I think since the low of 2008, 2006. Sorry, 20 years. So in terms of sales volume, we're at record lows. In terms of actual listings, we're actually at, I think, near record highs. When it comes to mortgages, and that we're seeing rising bond yields and seeing rising mortgage rates, that's obviously not going to help people buy or sell. It actually is a big kind of adherent to. So the thing about the housing market, I'm no expert, but it is a slower moving market. You can have 20, 30% crashes in the stock market in a relatively short period of time. We've obviously seen that you can see 20, 30, 40, 50% corrections in the metals markets, which are normal for being within the bigger context of a larger bull market. These types of drawdowns are common, but you can see those types of moves in other financial markets. But in real estate, it's just a much slower moving beast. It does not correct as quickly. So, I'm quite bearish long term on housing, or even in the medium term, but how and when will that correct? But I see this trend a lot. For the better part of the last 2 years, I have pretty smart clients that have actually been selling second properties or downsizing because the kids are out of the house, selling their bigger home to be able to come up with a bunch of cash to protect that. And for a lot of folks, their home is their retirement plan. Well, it's not going to bode so well if we have a 20, 30, 40% drawdown in housing over the next 5 years. So I think it's definitely a market to be watching. It's definitely a market to be concerned about. But again, I'm no expert on housing, so I'll stick to what I know with gold and silver.
And we got one more then. Back about at 1800 5 years ago, it must be gold.
Yeah.
So would you be under what circumstances would you be looking to sell gold? Like when does it make sense right now to sell some precious metals? Like,
yeah. So this other question is, I bought gold and silver 5 years ago at 1800, and when should I consider selling or taking profit in metals? Look, there will be a huge bubble in gold and silver at some point. In my estimation, the peak of the current bull market that we're in should come in and around 2030, 2032. Look, I'm not selling my financial insurance while these other bubbles have yet to pop. The amount of capital that's actually going to flow into gold and silver after the stock market bubble pops, housing bubble pops, and the bond market breaks is unimaginable. Gold was at an all-time high in 2008 when the stock market crashed by 50%. And yeah, gold got hit a little bit at that point in time, but then gold tripled in the next 2 years. So gold went from near an all-time high, $600-700, 2007, 2008, to $2,000 in 2011. Right. So from the bottom of the crash in 2009 to the peak in the metals market in 2011, gold tripled. I think we could see something like that once the catalyst to pop these other markets has all of that capital running away from those markets and looking for safety in the safe haven assets of gold and silver. You can't imagine how high these prices are going to go. Now, that's what I said. It's financial insurance, and they also are the best paying and most rewarding asset classes during the right setups, and we're in that now. So I will be looking to take personal profits in gold and silver, but only after we see this other big run, and you need these other crashes to occur first. So in my, again, estimation, 2030-ish, 2032, somewhere in there, we'll probably have a bubble in metals. Now, if you need liquidity or you need to sell like our clients do, you call us up. You can get back to cash, no questions asked, super simple. But if you don't need the money right now, I can't think of a better place to still have it parked than in gold. You've obviously done very well from 1800 to 4500 today, but 4500 is nothing compared to where it's going.
So you envision a lot of rotation out of stock market into precious metals. That's how you see it happening.
Yeah, capital rotation is inevitable. So the question was, do we see a big capital rotation out of those other markets and into gold and silver? Absolutely. It's just a matter of when. Most people aren't proactively diversifying their portfolios into safe haven assets. They will only reactively come into the gold and silver space once they've lost enough in the other markets that they're then looking for protection. And unfortunately, that's just the way it's always gone and will go in the next one. So having it now, like I said, is maybe a little early, but rather be early than late. Sorry, there was one last question that came up on the screen there, and then we're going to wrap this up.
I think it was bought silver at 18. The buyer bought silver at 18, so they're
Oh,
well in
awesome.
profit
Yes.
now.
So good for you. Good for you, Marita. So absolutely at 18, you're laughing all day long at 60, 65 bucks. You were laughing at 120, but that again is nothing compared to where we're going either. And yeah, I would just sit on that stuff as long as you can. If you do have other parts of your portfolio that are overexposed to riskier assets, then I would look at trimming those. I wouldn't look at trimming your insurance right now. All right, folks. Well, that's pretty much it. Lots to cover today. Thank you for the questions. And in the background, thanks to JR for facilitating this, and happy to do this again next week. So I'll sign off here. Good luck to everyone. Take care. Be well. And give us a call if you need to talk to anybody who's an investor that can help you set up your precious metals IRA, help you do home deliveries, any interest that you have in gold and silver. Give us a call. No pressure, no stress. And you can reach us at 877-646-5347. And again, it's Micah with another live stream. Thank you all very much.